Over 85% of crypto traders lose everything within 90 days. But here's the part they don't tell you. It's almost never because their strategy was bad. Imagine a trader. Let's call him Mark. Mark turned $1,000 into $1,500 in a week. He felt like a god. Then, in one single Tuesday afternoon, he lost every penny. I'm going to tell you the one mistake Mark made that changed his life. But first, we need to understand the environment he was playing in. I'm Olivia. This is the Strategy Lab by Crypto Simplex. We don't just trade, we survive. Think of crypto trading like scuba diving. Your capital isn't your money, it's your oxygen tank. If you don't manage it, you don't just lose the game, you stop breathing. Most people dive without a gauge. And stay with me, because in a few minutes, I'm going to give you a mathematical cheat code where you can actually be wrong 60% of the time and still end up richer than when you started. But to get that math to work, we have to build your armor. Here are the 7 rules of the Crypto Simplex risk playbook. The first commandment, never dive with a leaky tank. Only invest money you can afford to lose. Because crypto never sleeps, the emotional pressure of using rent money will force you to panic sell at the exact moment a pro would be buying. Only use risk capital, money that, if it disappeared tomorrow, wouldn't change your daily life. In the wild world of crypto, you need 2 things, a shield and a goal. These are your stop loss and take profit orders. A stop loss is an automatic sell trigger that activates if the price drops to a certain level. It's like a seatbelt. You hope you never need it, but you'd be crazy to drive without one. Without it, a small 5% dip can turn into a 50% burnout before you even wake up. On the flip side, we have the take profit. Greed is a silent killer in crypto. Many traders watch their account go up 50% and think it'll go higher, only to watch it crash back to zero. Defining your exit point before you enter the trade helps you avoid being swept away by emotions when the market gets exciting. But what if the price drops so fast the market skips your stop loss? This is called a gap. For those moments, you might consider a guaranteed stop, which ensures your position closes at your exact price even during extreme volatility. This is the most common beginner trap. If you have $1,000, don't bet $1,000. Professional traders never risk more than 1% to 2% of their total account on one trade. If you lose 50% of your tank, you need a 100% gain just to get back to zero. Protecting the oxygen you have is always easier than finding a new tank at the bottom of the ocean. Now, remember that cheat code I promised? It's the 1 to 2 risk to reward ratio. For every $1 you risk, you must aim to make $2. The math. Take 10 trades. Lose 6 of them. You lose 6 trades. They cost you $1,200. You win 4 trades. They make you $1,600. Final result? You're up $400, even though most trades failed. We've all heard of diversification, but in crypto, it's vital. Don't go all in on one single altcoin. Instead, spread your capital across different assets, like Bitcoin, Ethereum, stablecoins, or even different asset classes like stocks and commodities. Think of your portfolio like a garden. If you only plant one type of flower and a specific bug comes along, your whole garden dies. But if you have a variety of plants, your garden stays green, even if one species struggles. You can even use crypto indices or baskets, which automatically balance your investments for you, making diversification effortless. Now, let's talk about the double-edged sword, leverage. Leverage allows you to trade with more money than you actually have. It can multiply your profits, but it can also burn your account in seconds. High leverage, like 50 times or 100 times, means a tiny 1% move in the wrong direction can wipe out your entire position. New traders should start with spot trading, where you actually own the coins, before even touching leverage. If you do use it, keep it low and treat it as a tool for capital efficiency, not a way to get rich quick. Even the best math can't save you from a bad mindset. Let's talk about the mental trash bin and how to handle a losing streak. The biggest enemy in crypto isn't the whales or the hackers, it's you. Specifically, emotions like FOMO, fear of missing out, and FUD, fear, uncertainty, and doubt. When you see a coin pumping, your brain screams, buy! That's FOMO, and it often leads to buying at the peak. Conversely, revenge trading is when you lose money and immediately try to win it back by taking a bigger, riskier trade. This is a canon event for traders that usually leads to blowing the entire account. A professional trick is the mental trash bin. Before you enter a trade, mentally burn the money you are risking. Imagine it is already gone. If you can truly accept the loss before it happens, you won't panic when the price fluctuates. If you can't imagine losing that money, your position size is too big. So, what was Mark's one mistake? He didn't have Rule 3. He put his whole $1,500 into one sure thing altcoin with no stop loss. He didn't lose because the market was mean. He lost because he didn't have armor, but you do. If you want to raise your win rate from a beginner's 15% to a pro's 50%, start a trading journal today. Track your emotions, manage your risk, and let compounding do the heavy lifting. If you found this helpful, hit that subscribe button for more simple crypto guides. I'm Olivia, and this is Crypto Simplex. Stay safe out there, and remember, protect your capital first, and the profits will follow.